Good morning. This is going to be a little bit about what can happen to people who do things like flipping houses for a living, depending on how they treat their profits. Okay. So, and this is kind of spinning off of a video from a long time ago about the issue of cash being king, which a lot of self-employed people perhaps still embrace that whole concept. But when it comes to Social Security benefits, it is your Achilles heel. It will potentially prevent all Social Security benefits, disability or retirement, depending on how rampant the whole concept is in someone's practice throughout their life. So that prior video, and I'll try to link it, was about the concept of cash as king and how it can really destruct your financial future when it comes to Social Security, disability, or retirement. And forgive me, I could see my voice is like a frog. So in this case, this came up yesterday, and I feel badly for the person, but there's nothing that can be done about it until they start doing something about it. And it's almost like a decades-long situation. So let's say someone spends years flipping houses and makes a profit on each house. And let's face it, flipping houses is work. That's work activity. However, apparently, some tax professionals, without thinking about the big picture, and I wish they would open up their eyes a little bit more on this, help or encourage or facilitate the use of certain IRS laws where you can categorize apparently. So this is just apparent because I'm not a tax professional. The profit from the house flip that one worked really hard renovating that house for the flip, right? And just categorizing it all as capital profit, right? Capital gains. And capital gains are like the gains on investment. And there is no Social Security tax on that, right? None of that payroll tax. Whether it's as a self-employed person, you pay both sides. What would be the employer, but you are the employer, and what is the employee, and you are the employee. You pay both. We pay a huge amount, right? Because it is separate from your income tax, right? It's an additional burden. But it goes specifically towards your future benefit. So it's very for the person who pays it. So if a person categorizes all of that work effort, the income generated from that work effort, that apparently can also be designated as capital gains and not working income, if the person doesn't take a paycheck, you have no Social Security credits for those years. So within a few short years, if that's what someone does and they don't have a W-2 or other self-employed income that they are reporting enough to gain those 4 credits, in short order, within a few years at best, they're going to be uninsured for Social Security disability. And if they haven't already worked 10 years and earned 10 years worth of credits, 40 credits of SSA credits, they will not have retirement income either unless they return to work in some fashion where they're actually paying for Social Security insurance. So if you don't pay those premiums, people, you're not going to have the insured status. So the only remedy then, if you go all these years flipping houses, making your big profits and just calling them capital gains, yeah, you escape that Social Security tax, but you also are up a certain creek without a paddle. If you become disabled later, as you get older, maybe you hit your 50s, maybe your late 40s, and things are flying south for you, and you don't think there's anything that you can really do work-wise, full-time. You might be relegated only to SSI, but of course, if you have more than $2,000 in resources, and that includes money you put in a mattress or in a piggy bank in your house. I mean, most of us have a cash storage someplace for an emergency. That money counts. How evident it may be is not really the issue about the fact that under the law it counts and you're supposed to report it when you file for SSI as a resource. And you know, at your own risk if you fail to. But the issue of putting all of the capital gains as capital gains is a dangerous one, I think. Unless you're a multimillionaire, and whether you become disabled or not, it's not going to be relevant financially because you got more than enough money to take care of yourself. But so just a consideration, if you're flipping houses, pull at least some sort of tiny paycheck. You know, again, to earn 4 credits, it doesn't take a lot of money. So like in 2023, $6,560 will get you all 4 credits. It's going to go up in 2024 slightly. So if you just took a paycheck, a puny paycheck for the sweat equity you put into flipping that house, there's probably a ton of other business ventures like this, entrepreneurial ventures like this, that the same would be true for. But this is the one that came up yesterday. And unfortunately, the person has no SSD insured status, and may or may not have retirement insured status, because that once you get that, you keep that. So it really depends on the prior years of work that the individual had as to whether that would be something. But for now, there's no disability in terms of Social Security disability for that person. And again, if you have SSI, which could be an option, it's only if you're super poor and don't have those resources, or other areas of income that go beyond, you know, the amount of SSI will allow. So again, consideration of giving yourself a paycheck, even if it's only worthy of a part-time minimum wage, but at least giving yourself a paycheck to the amount of that 4 credits for every year. You know, that way you're going to give yourself the biggest window. If you do become eventually unable to do that house flipping or something else, you're going to keep that window open the maximum 5 years that you could have if you had solid credits right behind you in your rear view mirror. So cash is not always king. Sometimes you have to take take the hit on that slightly. I mean, if you think about it, if you take a small paycheck of $7,000 a year, and again, that's going to go in 2023 at 6,560, it's going to go up in 2024. Eventually, it's going to hit 7,000 as the minimum to gain all 4 credits. That's something you have to keep an eye on each year. We usually put it out there as the time comes. But our income tax, federal income tax, is 0 on that income. Federal income tax, because remember, in the 2017 Tax Reform Act, our standard deduction went from $6,000 for a person to $12,000, and incrementally raises, so now it's over $12,000. So you can certainly earn all that you need and pull a paycheck for all that you need for those credits without paying a penny in federal income tax. Now, whether your state has, every state is different in terms of whether they have an income tax of their own, whether they have a standard deduction or not, I suppose. So that would be up to your state. So you might have to pay something there, maybe not, because some states don't have it. I know mine does, and it's unfortunately a hefty little booger. And some people have local taxes, and we have that here too. In my area, we got everything. They hit you hard, coming and going. That's Northeast Pennsylvania, by the way. So consider taking up some. You don't have to take the whole thing as profit, as wage. Of course not. A lot of it is capital gains. But for your labor, I suggest you at least pay yourself something minimal that includes at least amount to get your 4 credits. And that's going to protect you forever forward. You know what I mean? Or at least for the 5 years if you stop working at all and having any tax paid income. Because when you stop paying those Social Security premiums through those taxes, and that's the Social Security tax, not income tax, that doesn't help you. Social Security tax. You won't regret it, particularly when you consider the amount of people that become disabled before age 62. And you also won't regret it, I don't think, because it's going to affect your retirement. It's going to it's going to prevent it from being decimated as much as it would due to not working at all and not putting in towards your retirement. So it's kind of like a win-win although you do give up a few bucks of taxes now. Okay, Social Security taxes on the 7,000, say, that you pull as a wage. You won't pay the income tax, but you'll pay the Social Security tax. And it's not pretty. I mean, it's going to be like 12+%, but it's something that's going to protect you later. So when you look at the dollar amount and you think, wow, you know, I have to pay that when I could otherwise shove it under the rug. Well, if you're going to do that and have the risk of becoming disabled, think about the price of a disability insurance policy that you buy on the open market. Most of us don't have it. We don't choose to buy it. We possibly should. I'm contemplating. It's just always when whether you're like, oh, can I budget that? You know, blah, blah, blah. I'm raising kids. I'm doing this. But if you look at what you pay for Social Security taxes and compare that to what you would be paying per month for a disability policy, that often does not even last till the rest of your life, like Social Security disability does, because then it turns into retirement. I think it might be, I haven't done the math, but I think it might be really worthwhile. And maybe I will get a couple quotes and take a look. Something to think about, guys. Cash is not always king when it comes to protecting yourself, even if it's just by getting those credits and not even putting in, you know, not necessarily working $50,000 a year or $100,000 a year, but getting in the amount required for that year's 4 quarters of credits. All right. Super important. Check it out. Bye, guys.